Hello, everyone. So in today's video, we are going to talk about, we're going to continue moving through our accounting cycle, and we're going to move on from step one to step two of the accounting cycle. So step one was analyzing transactions. And to remind you a little bit about what analyzing transactions involves, that's where we look at every transaction. In which a company has exchanged value. So everything that a business does is an exchange of value, right? The company is both giving and receiving. So we need to look at both sides to consider for everything what was given, what was received. And that's where this concept of double entry accounting comes in, because we are accounting for both sides, what was being given and what was being received. And we look at those things and we try to fit them into the accounting equation. Okay, so what we gave and what we received, is that asset, liability, or equity? Was it increasing or decreasing? And ultimately, we need to make sure that the accounting equation stays in balance with every single transaction. It's going to have to balance out. So as a reminder, the definition of accounting is an information and measurement system that identifies, records, and communicates information about an organization's business activities to help make decisions. Now, that first step of the accounting cycle, that transaction analysis, that's really the identifying part. Okay, we're looking at the transactions, we're looking at what happened, we're thinking about it in accounting terms as assets, liabilities, or equity. But that process alone is not the actual recording. Okay, it's just the thought process. It's just looking at it. It's not recording anything. Now, that step in the process is very important. We always want to make sure that we do that transaction analysis, that we look at it, at the transaction carefully from accounting terms. And once we've done that and we've gotten it right, like we've figured out how to make it fit into the accounting equation, it makes it a lot easier to actually record those transactions and get them into the accounting system. So the way that we actually record transactions is through what we call journal entries. So again, step two is recording business transactions through journal entries. And journal entries are how we translate business transactions into the accounting language. Okay, it's just a translation. So we can't, when we're recording things, it's not very efficient to record everything as a sentence. The company provided consulting services for a customer and received $500 in return. That's a long sentence, and it's just not the most efficient way to record it into accounting system. So we have a different way that we record that into the accounting system that is much more efficient and helps us to gather information easily. So this is what a journal entry looks like. Okay, and it has, as you can see, 5 components. So the first is the date of the transaction, and that goes in the far left column. So it's very important to date your transaction so that we know when it occurred, because those accounting periods are very important in accounting. You want to know what happened in 1 month versus another month. The next column is for the account names. And so what you see here is a list of the accounts that were exchanged. So in this particular journal entry, what was exchanged was cash for common stock. So we put each one on a different line. The next column you see is for debits and credits. Okay. And every journal entry is going to have at least one debit and one credit, maybe more. every journal entry is going to have 2 lines at a minimum. That's that double entry accounting, what's given and what was received. Sometimes it's one thing for another, but sometimes you might give 2 things in exchange for one. So there might be multiple lines in a journal entry. This is a simple one that only has 2 lines, and most of the ones you're going to be doing in this class only have 2 lines. Some will have 3 or 4 as we go along. One other important thing to note about journal entries is that the total debits will always equal the total credits. That must happen. The debits equal the credits. So again, there's that concept of balance that we've been talking about, where one side equals another. Same thing here with the journal entries. Your debits must equal your credits. The last piece is the explanation, and that's what you see here at the bottom. And that's basically where you translate the journal entry or the transaction back into English. So this line here, right, that's in English. This part here is accounting. And someday, if you continue with accounting long enough, you'll be good enough that even if you don't see that explanation, you'll know what this means. Okay, we'll know that cash increased, meaning they gave the company cash, and common stock increased, meaning that the owners got ownership in the business. So I'm going to translate that and say, oh yeah, the owners invested cash into the business, which is why the company's cash went up and the owner's equity or common stock went up. Okay. Now, a quick note on debits and credits. Okay, whatever you think they mean, throw those definitions out of the window. We're going to learn the specific definitions of debits and credits now. So if you think they have anything to do with debit cards and credit cards, get it out of your head. The sooner you get that, if you learn my definitions, the better off you're going to be. So in accounting, the only thing that is always true is that debits go on the left side. Oops. Debits go on the left side and credits go on the right side. And you see that again happening in the journal entries. So if you go back to the journal entry, right, you see that debits are here on the left and credits are on the right of the number columns, right? Debits on the left and credits on the right. Now, it really does mean more than that, but the thing is, what debits and credits mean are different depending on the account type. So, whether a debit or credit means increase or decrease depends on the type of account. So sometimes it means increase, sometimes it means decrease, and it all depends on the type of account. So here are what I call the debit credit rules, okay? And the rules go like this. If you're talking about an asset account, debits mean increase and credits mean decrease. But if you're talking about liability and equity accounts, it's the opposite. Debits mean decrease and credits mean increase. Okay. Now I want you to write these debit credit rules down on like a Post-it note or sheet of paper or something that you can have close by you at all times, whenever you're in class, whenever you're doing your homework, because we're going to be using these debit and credit rules all semester long. To add to the debit credit rules as well, to make it a little bit easier for you for some of the accounts, specifically the equity accounts, because the equity accounts don't go up and down the same way the asset and liability accounts go up and down. So let me explain. If you're talking about cash, right? Cash can go up if you receive cash, and cash can go down if you pay cash. So within that cash account, you're going to see ups and downs. That's not true of the equity accounts. The equity accounts only move in one direction. Okay? They only move in one direction. So instead, we look at it like, what are the accounts that increase equity, right? And we talked about this in those previous videos on the equity accounts. The accounts that increase equity are going to be common stock and revenue. Okay? By definition, they both increase equity, so they are always going to be credits. On the other hand, the accounts that decrease equity are dividends and expenses. So those accounts will always be debits. So again, when you write that in your notes, put it in your notes so that you have that in front of you. So anytime you're touching a revenue account, it's going to, you know, it's a credit. Anytime you touch an expense account, you know, it's a debit. You don't have to think so hard about it. But that's the reasoning why they are always that way, because they either always increase equity or they always decrease equity. So let's take a look at this process with an example of the different steps of a journal entry. So let's take a look at an example of how we do a journal entry using the transaction analysis we did before. So again, don't skip that step of doing transaction analysis, because that is going to make your journal entry a lot easier if you've already taken the time to do that step and get it right. So looking here, this is the example we did in class. This transaction number 1 says, on November 1st, Joe gave the business $3,000 cash in exchange for ownership of J&M Auto. So we determined that what was exchanged was that the company received cash of $3,000. So that's an asset going up. And in exchange, Joe now has ownership or claims on the assets of the business, and that is represented by common stock. So equity also went up $3,000. So now let's go ahead and put that into the journal entry. So what we're going to do, first thing is we are going to date the transaction. And this happened on November 1st. So we're going to put here November 1st. Then the next thing you want to do is you want to list out the accounts. Well, the two accounts are cash and common stock, as we've already identified here in our transaction analysis. The next thing we need to do is to apply the debit credit rules. So here is how we apply the debit credit rules. Okay. We first look at what type of account is it? Is it asset, liability, or equity? Well, in this case, we are looking at cash, which is an asset. So we go here to our assets, and we see that our cash is increasing. And an increase in an asset is a debit. So I'm just going to put in my notes here that this is a debit. Then we move to the other side, common stock. Okay, well, common stock is equity. So now we're going to look at our equity debit credit rules, right? And we see for equity, an increase in equity is a credit. So I'm going to put here just underneath credit. Okay, again, Transaction analysis is really your thought process, thinking about it before you actually record it. You can kind of think of it like before you write an essay, you are going to, do some brainstorming. You're going to organize your thoughts into an outline before you actually start writing the paper. That's the same thing here. That's what transaction analysis is. Transaction analysis is brainstorming, thinking about it, and then getting your thoughts organized in an outline before you actually record it in the journal entry. So when we go to record it, best practices are that you will list the debits first. So looking at the transaction analysis we've done here, I see that cash is going to be debited. So I put here cash as my first account. And next to cash in the number column, I put 3,000. Okay. I don't need to put plus 3,000. Or if it was minus, I wouldn't need to put minus 3,000. The reason why is because I already know if it's an increase or a decrease simply because the debit credit rules. The debit credit rules tell me that. Because I know that cash is an asset and it's in the debit column, right? I know that it's an increase. You don't have to tell me again. I just know it because I know my debit credit rules. Then we move on to the next account. The next account is common stock. So we put common stock. And now, since that's credited on that same line as the common stock, we're going to jump over and go to the credit column and put 3,000. Oops. Okay. Oops. And there is our journal entry. But we're not done yet, right? We've got to make sure that we have done step 4. That's really important, which is to make sure your debits and credits equal. So when I look over here, I see, oh yeah, I have 3,000 on the debit side, 3,000 on the credit side. It all equals out. Now this is pretty easy when there's only 2 accounts to deal with, but it could get a little bit more complicated when you're dealing with 3 or 4 or more line journal entries, because you'll want to make sure that your total debits equal your total credits. Now you notice here, I'm not putting in an explanation. In real life, yes, you're going to put an explanation explaining what happened. Joe put $3,000 into the business in exchange for ownership, but I already know you know how to say that. That would just kind of be repeating what you have here. What I want to know is, can you do this part? Can you do the journal entry? Can you figure out what is the debit and what is the credit? That is the most important to me. So I want you to focus on that. Don't worry now or in your homework or on the exams or anything like that about putting in an explanation. In real life, you will. In real life, that's what we do. But for homework and things like that, just focus on getting the journal entry part right, the accounts, the debits, and the credits. Let's do one more together so you can see what it looks like with a different example. So this one says, on November 2nd, Mo gave the business 2,000 cash and 1,000 of auto repair equipment in exchange for ownership. Well, now here's an example where there's an exchange that involves 3 different things. So we've got the company received cash of 2,000. So that's an asset going up. They also received equipment, and that was $1,000, an asset going up. And so in exchange, now Mo, the other owner, got common stock. So the way that one is going to look is, again, we want to date it. This time the date is November 2nd. Again, we want to make sure we think through our debits and credits first. So cash is an asset and it's increasing. So that's going to be a debit. Auto equipment is also an asset and it's increasing, as we see here. So that's going to be a debit also. Common stock is equity, as we see here, right? And our debit credit rules for equity, anytime equity increases, which common stock always increases equity, is going to be a credit. So that's going to be a credit. So now I'm going to go to my journal entry, do the same thing. I'm going to put cash because it's a debit. I want to list all my debits first. And I go to the debit column and I'm going to put 2,000 because cash increased 2,000. Then I'm going to put equipment, auto, and that increased by 1,000. So I'm going to put 1,000 there. Again, I don't need to put the plus or the minus. It's not necessary because I already know because it's a debit that it's an increase. And then common stock, I'll put here, and that is 3,000 increase. Okay. So that is how journal entries work. Again, if you take the time to do your transaction analysis first, it's going to make your journal entry a lot easier. So go ahead and practice this with the in-class activity worksheets that I put in Canvas for you. And if you have any questions, please let me know. Thanks.